reporter, Janice Mason. You can just let me know whenever you're ready to go on, start the recording, or whenever you're started, and I can go on
Okay.
the record.
Yep, I'm going to start now. And this is just a reminder that this is a public meeting of the Sinking Fund Commission. Um, it's being conducted virtually through Microsoft Teams, and by attending and or speaking at this meeting, you acknowledge that the meeting's being recorded, that your phone number or email address, etc., may be displayed on the public video that will be required to post pursuant to city ordinance. And with that, since I guess conducting this in Don's stead, the first agenda item is approval of the last meeting's minutes, the May minutes. I don't know if there's any comments or if there's a motion from any of the commissioners.
I make a motion to approve.
I'll second it.
All those in favor?
Aye.
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 Thank you. The next agenda item is an investment performance review for May, or, really, I think more appropriately, the more recent report, June of 2024. And with that, I will turn it over to Floyd and Alex for a review of the performance numbers, which should be visible on your screen.
Thanks. Floyd, you want to give an update for the last few weeks or so?
No problem. So for the last few weeks, what you've noticed, you ended the quarter really strong. If you're looking at it from just S&P 500, S&P 5 ended the quarter at 4.28. Year to date, posting return of 15.29. So if you think about it, this has really been a bounce back. Where has returns come from? It's really been on the back of the Magnificent Seven, and even if you're thinking about it from the Magnificent Seven standpoint, it's been really more based off of what's been going on with AI and NVIDIA. If we think about the return to date, about 30% of that 15% comes from NVIDIA. If you look at the rest of the Mag 7, everybody else makes up somewhere between 9% at the high side to contributing negative 3% on the low side. So it's a little bit more mixed, but as you can tell, it's really been all about NVIDIA this year within domestic stocks. You take it
I'm
out
gonna jump in
international.
real quick.
Go
I
ahead,
think
Alex.
it was like right after our last meet call back in May that NVIDIA posted their Q1 earnings, and I can't recall what it was, but like their revenue was up like 500% or something, or 250% maybe for earnings, right? I mean, it's and that alone, I think following that, it was the same week, I think, that there was positive CPI news back then, but the NVIDIA earnings report alone lifted the market entirely.
Yes. And if you're looking at it, just looking at it for July, what you'll notice in July is that you start to see small caps come back. So that's something that had been lagging for the beginning of since last year, even this year. But small caps have started to come back during the first portion and a couple beginning days of the third quarter. International hasn't done as well. Emerging markets actually were the main theme during the second quarter. Not China was part of the main themes, but really where you really saw it come from was India from their financial sectors, and then from Taiwan. And Taiwan is Taiwan Semiconductor. So what you're probably seeing within both domestic markets and international markets are in some respects mimicking domestic markets. You're starting to see it spreading out of that AI theme within the market. So that's where you saw Taiwan Semiconductor really get a bump during the quarter, and that being very positive for emerging markets. Last but not least, if you're looking at the ag bond, it had a very pedestrian return for the quarter. For ag bond, why was it a very pedestrian return? Spreads remain very tight. So if you're looking at the spreads on, let's say I want to say the corporate IG credit spreads, they're still below their normal they're still below their 2-year to 5-year normal rates. There hasn't been too much movement within spreads. You've seen a little bit of tightening, but not that, a little bit of widening, but not that much. If you think about it from the high yield aspect, if you were worried about a recession, high yield spreads still remain lower than their 10-year average. But if you're thinking about it from where we're looking at for high yield, the double B sectors look pretty good. The problem is the triple C sectors, and that's the portion that people should really pay attention to because they're starting to see more and more defaults, and that default rate is increasing. But if you were to look at the high yield spreads, it's still below its 10-year average. It hasn't really moved up that much, so you haven't seen that much widening within the spread curve for high yield. So that's kind of what's been going on within the market over the past couple weeks to quarters.
And then looking out, I would, 12, 18, 24 months, I think, we still favor, equities generally. I think, we're positive on, global expansion. There are some population issues in developed countries, China as well. But, Floyd mentioned this sort of AI, revolution or whatever that's going on. Which improves productivity. So, number of people, steady, but the amount of, output one person can do improving, generally speaks, is positive longer term. I've gotten other questions about the election, et cetera. We never really handicap that. I'm not going to give any credence to like a Trump trade or anything. I mean, I think vice president has looked pretty good the last couple days, so it's a toss up, honestly. I think, but if there are any questions on the markets, if not, I'll review the performance of the plan very briefly. All right. So this, I think, on the screen here, Chris, is June, I believe.
Yeah.
So you can see the 1 month net of fee return, just below 1.5%, behind the benchmark for the month. There we go. Largely, I think the return was impacted by a slight overweight the plan has towards to small cap. That certainly would have benefited things here in July, as Floyd noted. I can't recall exactly. I think it was that was a little bit of the around the assassination attempt. There was again I forget the exact catalyst, but as Floyd mentioned, small caps have recovered quite a bit here in the third quarter. Pine Bridge, nice 1 month return. They're behind on the year-to-date basis of their 3-year number, which has been a challenging period for a lot of active managers. They remain positive. So, if this is the final meeting, that may be the approach I've taken in just reviewing this. We're pretty confident in Pine Bridge's role and place within this portfolio. And I would say the same thing for the small cap. Copeland, not impressive, but a nice return for the quarter. Very good return on a year-to-date basis. As rates fall, we do expect Copeland to receive some, tailwind from that. Not to mention just their ongoing high-quality bias. The same thing is present in the in the Rumline small cap. Again, that's benchmarked to the S&P 600 as opposed to the Russell 2000. A bit of a drag so far this year, compared with the Russell 2000. And I imagine that would probably be exacerbated. I don't have the data in front of me, with this rally that's happened in the last 2-3 weeks. But even when you look out over the 1 year, the quality bias of the S&P 600 is evident. So, or excuse me, not the 1 year. I can't. The 3-year period, and beyond. The quality bias of the S&P 600 is evident. On the international front, again, no real. So again, we leave the small cap, the weightings, the components benchmark to the 600 for the passive. No concerns or long-term issues there. And I would say the same thing on the international front. More of an active component here. We're confident with that. That's something. I think our discretionary portfolios have a fairly high degree of active within the international space right now. Good return from Acadian, less so from Ernest, but I think, again, on a year-to-date basis, both looking quite good. So no issues. And then on the fixed income, I would say the same thing. This almost right on top of the benchmark, both benchmarks really. As Floyd mentioned, their spreads are tight. There's not a whole lot to be gained here and there, but it's an area where we still favor being 100% active over the long term. And I think especially once rates fall and things get back to where we had been maybe a year ago or so, excuse me, even more of an opportunity for actives. But not really anything to call out here. Garcia Hamilton, moving in the right direction. Sky Harbor as well. Strong performance. No performance concerns there. There was a recent development with their firm. I'll go into that now, I guess. About 2 weeks ago, it's funny, Sky Harbor, going back to their founding, I think they had backing and a lot of capital from AXA, which is the European insurance firm. A lot of the investors, or maybe I don't want to say roughly 40% or so, were from those European days, was European domiciled capital. And a lot of it was invested in a ESG, I think specifically environmental, version strategy, avoiding oil and gas. Those European assets were sold roughly 2 weeks ago to a European firm, and it included the team members responsible for that strategy. The news we received at the time was, Sky Harbor was in the final talks exploring a sale, merger with an American-based firm. We got news, that firm was Pew Capital, which is a firm that's been around for a long time. We've used them in the past and still do on a very limited basis. But I think one of their founders, I can't remember, Scott Griswy, I think his name or something. He's sort of the figurehead there. He's in a chief strategist role. He our view of this initially is he's probably on his way out and obviously they see the team at Sky Harbor. They've acquired some other, let's call it boutique management firms in the past at Pew. So they're assembling some talent while also, assisting in, Pew's and, Sky Harbor's, transition as well. So, we're okay with moving, this to watch list. I think, long term, we this shouldn't be an issue. I think ultimately it's, a positive development for both firms. Sky Harbor has always had a great deal of talent. It's a diverse firm. It's been, not just, woman owned, but woman led from a PM and chief strategist standpoint. I think a few years ago, Mary stepped down and into a reduced role, and that's shifted over time. So, it should be a positive development, but we're okay with moving, Sky Harbor to watch list. pending just, a month, let's say 3 months, and, waiting for the acquisition and integration to shake out. But, other than that, we sort of, we kind of leave this portfolio, in obviously good shape from a return standpoint. I think roughly, we're about 2 percentage points or so overweight to equity. As you recall, we went back to neutral at the beginning of the year. That's obviously with 15+% equity return that's drifted up over the course of the year. Chris and I we continue to trim to raise cash. Again, I think almost entirely from equity. No rebalancing recommendation at this time. I'm trying to, I think that's generally it for my comments and, any other final issues. Again, no other theme. We've sort of, done a good bit in our time here, lowered fees, simplified the portfolio. I think everyone here has been on the phone when we explored alternatives, made the decision to progress, then kind of reconsidered that decision. Again, no, from our standpoint, no dire need to revisit that discussion anytime soon. So, and then again, from I think a fiscal standpoint, the city's been over contributing. The discount rate has been lowered. So, all said and done, not a big headache for you all from this plan. So we're pleased with the work we've done. It's been an honor. Sorry you guys can't see me today, but I'm kicking back. But you'll, obviously Floyd and I are, we're residents, customers, and we'll be around. So any questions? Obviously we'll work with the transition. We'll share performance. Amy and I have been tracking fees. That will be shared, and whatever we can do, in the meantime and ongoing. So that's it.
Thanks, Alex and Floyd. Any questions from any of the commissioners for PFM?
Just a comment, Chris. Floyd and Alex, I just want to thank you for your service and your good work on behalf of the sinking fund. I've followed along even before I became a designee, and the work has been good. And as Alex said, the fund was streamlined, simplified, and I think fees lowered, and I think that's to the benefit of the members. So we will miss you guys, but thank you both for your good work and dedication.
Thank you.
I'd like to echo those remarks. Thank you very much.
Thank you, everybody.
Yeah.
It's been great working with everybody.
Yep. So you want us to hop off now?
Sure. Thank you. And, I echo Fran and Don's comments, and obviously, I'll be in touch with you guys over the coming days and weeks on any final issues, but appreciate all the work you've done since you've been the consultants on the plan.
Yeah, and it's been a collaborative effort. So we'll leave it with that. So good luck, everyone. We'll talk soon. See ya.
All right.
Yeah. Okay, that takes us to agenda item 3, and I'll pull up the general investment consultant finalist report. I won't go through the entire report. Obviously, I'm happy to take questions both before the finalists come in or after. But at a high level, there was a contract, or there will be a contract expiration for PFM. And through the city's mandated process, we initiated a public search on eContract Philly. RFP was up roughly 5 weeks back in March and April. 5 firms submitted bids, and as you're aware, the incumbent PFM chose not to rebid, and that's primarily due to moving away from this type of consulting and to more of an OCIO model. I reviewed the responses for compliance with required minimal qualifications. And two of them were eliminated during that initial screening for not meeting minimum criteria. Third firm was eliminated due to a fee structure that was found to be wholly uncompetitive. Reviewed the remaining two applicants, considered multiple factors, spoke with them both numerous times, traded emails and files with them as early back as May. And the two finalists you'll be hearing from today, Marquette Associates and NEPC. Over the 9-page report, I've endeavored to provide basic firm information, on client coverage, their percentage of their pension fund, or percentage of their clients rather that are public pension funds. You'll also see their initial fees as well as their final proposals, their best, last, and finals. And I try to give a high-level sense of their prior experience, how long they've been in business, the philosophy that the philosophy they would bring to this consulting relationship if they were chosen. Also go through how they would control risk and risk management in the plan if they were selected. You'll also see whether or not the two firms requested exceptions to the contract terms. You'll note that on page 4, Marquette did not. And I'm just scrolling down for the recording. And you'll see, I believe that, and if it's not in here, it was wholly inadvertent. I believe NEPC did request some minor contract changes. Yeah, there it is on page 7. I'm sorry. Mainly related to contractor responsibility, indemnification costs, and some issues around electronic signatures. So with that, NEPC is scheduled to present first for roughly 20 minutes, subject to Q&A, followed by Marquette. But before letting the first team in, I'm happy to take any questions that folks might have at this stage. All right. Hearing none, I'm going to let the folks from NEPC in, just, kind of lay the ground rules for them, and then they'll get started. Good morning. I see, I believe all 4 of the folks from NEPC are in the room. You'll have roughly 20 minutes to present. I'll try to, put up my hand or use something on the screen when you're getting close to time. I'll be mindful if there's Q&A to, kind of factor that in. And I'll have your presentation up on the screen. So if you want to tell me when to flip through or refer to other slides, I'm happy to do that. And with that, Margaret, Deanna, Sam, I'll turn it over to you folks to get started.
Deanna, I think you're on mute and you're not sharing your screen. I mean, sorry, you're not sharing your video.
Uh-oh. Deanna on? I don't know if
I assume the DJ I'm seeing on the first is Deanna.
sorry for the technical difficulties.
No, it's not a problem. I just admitted her a second time. It could be on our end. So
Oh,
there
there
you
she
go.
is.
Yep.
Right.
Good morning, everyone.
So whenever you're ready to start again, I'll give you the high sign around 20 minutes, and floor is yours.
Okay, Great. Would it be okay if we share screen instead? Oh, I'm sorry, you're on mute.
Let me see if I can turn over the control to you folks temporarily.
That works too.
And if not, we're happy to call out page numbers and let you change them.
Yeah,
I'm
absolutely.
having some difficulty here, so if you wouldn't
Okay.
mind going
No
that
worries.
route, I apologize.
Don't worry, that's okay. Well, thank you for inviting us in today to have a conversation about NEPC. My name is Deanna Ingram Jones. I'm a consultant with NEPC. I'm based in our Chicago office. I'm joined by three of my colleagues. We brought our fearless leader here, Kevin Leonard. Kevin is based in Boston. He is responsible for managing the public fund and Taft-Hartley team. So public funds similar to the sinking fund and our Taft-Hartley or our union clients. I'm also joined by the leaders of the client team, if we're fortunate enough to work with the sinking fund, Margaret Belmondo. Margaret is based in Philly. She's a partner on the public fund team, and she's also responsible for managing the public fund team. And also Sam Austin, who we got up very early. Sam is based in California, and he
Got my
services
coffee.
yeah, I know. I got a couple of them too. He services public fund clients also. So I know we only have 20 minutes to talk to you today. And as we have this conversation, we want to leave you with two things, really summed up in one sentence, that we are big, but we think small. And so when you're hearing from Kevin, Margaret, and Sam and I, you'll hear about things about the robustness of our resources, things like our 70-person research team, or our state-of-the-art tools that we have to build investment programs, such as our asset allocation tools and our portfolio construction tools. Those things will seem really big from NPC, and we are. We don't steer away from being big, but as your client service team, Margaret, Sam, and I are responsible for making sure that you never feel that bigness of a big firm. So we're really responsible for essentially being the Rosetta Stone for the sinking fund, making sure that we're acting as an extension of staff and really providing the best services that you need to build a successful investment program. As we go through this presentation, we would love for it to be interactive. So as you have questions, please feel free to chime in and let us know how we can make this a good use of your time. So with that, I'll turn it over to Kevin so he can talk about the firm,
Great.
NEPC as a firm. I think it starts on page 3.
Number page 2.
Or I'm sorry, 4.
2.
Yeah, one more. Perfect, right there. Thank you, Chris. And again, thank you, Deanna. So just a few minutes here on who we are as a firm. And I think to start simply saying that we are a privately held independent consulting firm who has structured our firm to be 100% focused on our clients. You'll see here today we have 357 employees across our 8 regional offices, headquartered in Boston, recently opened our first non-US office over in London. Today, we're owned, again, privately held, owned by 50 partners with not one partner owning more than 5%. And on average, the ownership across the 50 partners is less than 2%. So very well distributed across the partnership. I think of importance is 100% of our revenue is from our advisory, consulting, and OCI services. We have no conflicts of interest. We don't manage money. We don't sell our research. We're not a broker-dealer. We are 100% consulting firm focused on our clients. As Deanna said, yes, we are a large firm. However, we're set up into practice teams, focusing on our underlying client types. So obviously today, the 4 of us sit on our public fund team. Again, 7 practice groups. Today, we have 427 clients across a very well diversified firm. You'll see we have corporate clients, nonprofit clients, healthcare, high net worth individuals, Taft-Hartley, and particular to you today, our public fund practice Today, we have 73 clients within our public fund practice, and I'll get into a little bit more detail. I think the one takeaway beyond what Deanna said is hopefully is that we love what we do. We've created a culture of bringing people in that really love consulting, and again, focusing 100% of our time on our clients. And then separate to that would be our research group. Research is the engine that drives NEPC, very unique to the consulting business when we have a separate dedicated research group, which helps assist us on the consulting side. Page 3, to give you a little bit more detail on our public fund practice. You'll see again, 73 clients, total assets under advisement, just shy of 800 billion. So when we think about the public fund group, there are other consultants in the business that have chosen to get out of the public fund space. We have been working with public funds since the first day we're in business. Today, it is the largest practice group by assets under management. And more importantly, it is the largest practice group from a revenue perspective. So the revenue that contributes to the overall organization. You'll see today we account for 47% of the total NEPC client assets. Our average client size is just shy of 11 billion with a median client size of 2.6. We have a dedicated team specifically to just public funds. Again, as Deanna mentioned, led by Margaret, of 18 professionals and 16 partners. And on the bottom right here, you'll see our client retention. 81% of our public fund clients have been with us for 5+ years. And on average, our public fund clients have been with us for 13 years. And then finally on page 4, just a couple of kind of snapshots of our overall public fund clients. I think specific to you all within the city of Philadelphia, we work with the Philadelphia Housing Authority, which has been a long-term client. And then both Margaret and I work with SEPTA. I'll stop and pause there, see if there's any questions particular to the organization. If not, I'll turn it back over to Deanna.
Thanks, Kevin. So if we can go to page 7, we can, in the interest of time, kind of hop into what we would do with the portfolio. So one more page up. Sorry, 9. So as we, and this page is intended to be strictly illustrative. It's based on the publicly available information we had about the sinking fund. So not prescriptive in nature. What we really wanted to do is show you what kind of thoughts we would go into us constructing a portfolio. So we looked at the portfolio. Right now, you kind of sit with a mix of public equity and fixed income. Within your policies, there's a target of 10% alternatives. Alternatives are interesting, absolutely add alpha to the portfolio, but it also, as a newer investor in private markets, requires some education and comfortability around that. So we would 100% understand if that target to 10% is not something you're really ready to go into. And we can also think about more liquid ways of investing in private markets besides the traditional venture capital. So as we looked over your portfolio, a couple of things we noticed and kind of thought about. So growth has been, no pun intended, a growth engine for the market over the last couple of years. And so you've seen a lot of return from the growthier pieces of your portfolio. As we're constructing portfolios for clients, we really want them to think about where the ball is going, not where it's been. So some of the recommendations would be to kind of trim some of that growth exposure, take some chips off the table and move into more value position or a neutral core piece of your portfolio. Another opportunity for you, particularly if there is no interest in adding to that private market portfolio, is adding something like global equity. Will you have an opportunity to work with a manager who is unconstrained by style and geography in order to really be an active part of that portfolio, more alpha seeking. Also, you have a relative overweight relative to the MSCI ACWI IMI for your international versus domestic portfolio. So kind of revisiting that and ensuring that it still meets your return risk perspective. Within your fixed income portfolio, your credit portfolio, there are a lot of overlap in security types. So kind of taking a step back and looking at the beta exposures you have within your portfolio, maybe trimming some of the risk by adding a passive tips Treasury. I know you all just did a search for a passive fixed income manager at the last meeting. So kind of revisiting the risk budgeting within your credit portfolio. And then if we look at those numbers below, we ran this model portfolio with those things we just discussed through our asset allocation tool, and it spits out numbers. An important thing to understand about these expected return is kind of two things. So one, they are beta only. So this is with the expectation that you would be 100% passively managed. And so that's where a tool, which Margaret and Sam are going to talk about a little bit later, our portfolio construction tool, where we really look at the alpha generated by managers, really comes into play, because asset allocation is a huge part of the return that you'll get, but manager selection is also important. Also, leaning into our research and our thought leaders on research to discuss how you're spending your active management dollars. Are you really getting the bang for the buck with regard to how you're spending active management? That's also an important part of how you get returns in the portfolio. So if you, and I won't spend tons of time because once again, this is just illustrative, but as we think about how we get you to that 7%, you see these illustrative portfolios have a higher return or get you closer to that 7% than your current allocation. And also, if you look at the Sharpe ratio, you see it works a little bit better. So I'll pause because I know that was very quick and see if there are any questions on that. And if not, I'll turn it over to Margaret to talk a little bit about our research team, our crown jewel.
Yeah, Chris, if you don't mind going, it's our page 15, so it might be your 16.
I think so.
Yeah. Did I get that right? There we go. Yeah. Thanks. Perfect. Yeah, if you scroll up just a little bit more to see, there we go. Perfect. Thanks, Chris. So I always enjoy talking about our investment research team. It really is the cornerstone of what drives our firm and also innovation. You'll see here we have 69 investment professionals on research, and they are separate and distinct from consulting. So while you all and staff will have direct access to our resources and research, their responsibility is solely to find the best managers and also to monitor portfolio or managers as well. So it's, there's a couple of different teams that are dedicated within the research team that I'll talk through, but that's important. We think this is a differentiator. Not only is it one of the largest research teams across the investment consulting industry, but having that direct access to them as well is really important. But at the end of the day, it is Deanna, myself, and Sam who are responsible to ensure projects are handled from day one to the end. Forgot to mention, I am based in Philadelphia. I live in Bryn Mawr, and would be more than honored to continue to grow our NEPC family in the Philadelphia region. So more about our team. So our research team, we have 19 partners and principals that within research. That's really important too, because we were impacted by the Great Resignation a few years ago, as everyone was. And how we resolved that is we looked at our younger talent. We made them partners and principals. We want to create stability on our research team. We want to create a career path at NEPC for our employees. We don't want NEPC just to be a stepping stone to move to an asset manager firm. So that's really important. When you look at the makeup of the team, 40 members have advanced degrees, 42% are diverse, so minority or female members. And the experience that they have is we've brought people over from the LP side, so people who have worked on your side of the table, who worked for endowments, family offices, pension funds. And we've also brought over people who have GP experience, so people who've worked for buyouts at real estate and other asset managers. And why that's important to you is that it's about access. So while that 1.6 trillion assets under advisement of NEPC is big and it provides scale, access is also about networking. So, we're really proud of our team for having built such great relationships. It's a testament to our quality of our team. And so if you did want to tap into some private markets, this would be a great area, and the ability to access such wonderful top quartile managers that even our largest public fund clients have access to, we can provide access to across all of our public funds, regardless of size. So that's a wonderful benefit. Couple more things here. 40.4 billion of assets are diverse owned for our clients. So we're going to talk a little bit more about the DE&I efforts and negotiated client fee savings of 76 million. That's an annual number. So what that means is, that's going back into the pockets of our clients. We are not receiving any of that. We do not receive any revenue except from our clients, but we do negotiate hard on fees. And that's because we have such scale. So if you go to the following page, I'll just quickly talk through just these 3 different areas within research that are really important that we would work with you all and our research team. One is asset allocation. So you heard Dee talk a little bit about it earlier, but we develop over 70 asset class assumptions, and we do it quarterly. And we develop strategic asset allocation views, which are more long-term. And then we also have more dynamic asset allocation views, which are more shorter term, that could be more around 3 to 5 years. So these are areas that we will work with you on a regular basis, and they get updated regularly as well, depending on the macro environment. Then if you look at the bottom right-hand corner, you'll see where it says investment strategy team. That's the manager research. So think of that as the bottom up, finding those best names, also doing due diligence on names. And then that middle piece there on the top right where it says portfolio construction team, think of this as the purpose of this team is marrying the asset allocation with the investment strategy team. So think about how we would actually implement. So we have the asset allocation, we have great managers. Now, how would we implement and optimize the portfolio? So this is where a lot of the quantitative risk analysis lands. And there's a lot to that. I know we only have 20 minutes, so I'm gonna pause there because there's another page on the following page that just shows sort of the high level of the professionals and leads of each of the teams. But I'm going to turn it over to Sam because he's going to talk more about investment strategy and our process as it relates to finding those great names.
Thank you, Margaret. Appreciate that. And in the interest of time, I'm going to give you the high-level takeaways. On page 21, please. We talk about our investment framework. And again, this is just the specific part about manager research, which again, Margaret painted that in the context of marrying that with asset allocation, which is the most important decision, and portfolio construction. You can't just find the best managers. You have to find how do they interact with the managers currently in your portfolio. So within manager research, this is led by Sarah Samuels, our head of manager research. Sarah comes from your side of the table, having been in the investment C-suite for the Massachusetts Prem organization, as well as other investors that happened to be NEPC clients. She knew us and liked us well enough as a consultant that she came to head our manager research team. You can see here that we focus on this concept of second level thinking, which was popularized by Howard Marks, the founder of Oaktree, in his book back in 2011. He talked about the fact that second level thinking is required to understand what's in the long-term interest of investors. First level thinking is characterized as kind of the obvious. What has their performance been? Look at the usual 4 Ps: people, philosophy, process, performance. Anyone does that. But what we've done is add these additional tools, which you'll see on this page. On the left-hand side, proprietary quantitative tools. On the right-hand side, a inexorable focus on alignment of incentives for our clients. On the proprietary tool side, I'll give you one example for lack of time, that we look at not just how has the performance looked over the last 3, 5, 10 years. We try to understand what are the embedded factor biases already in that manager. So if that strategy has an embedded factor bias, we don't count that as skill. That's what's already built into the process. What alpha have they produced beyond what just a cheap exposure to those factors would have given you? That's an example of choosing between luck versus skill. On the right-hand side, alignment of incentives really goes to speak to another chart that I'll finish with, which is making sure that our managers are working in your interests. So if you would go, please, to page 27, I'll emphasize that NEPC uses our size, our influence with those managers to negotiate fee savings on behalf of our clients, like the Sinking Fund. So we have negotiated over $76 million worth of annual fee savings for our clients across almost 600 investable vehicles that include public and private markets. So I'll finish there and turn it back over to Deanna to conclude our presentation. But at the end of the day, as Deanna said, this is the crown jewel of what drives great performance for our clients at NEPC.
Great. Thank you. Thank you, guys. If we could go very quickly to page 35. This talks a little bit about our DEI efforts, and we wanted to round the conversation out with that note. So a couple of takeaways just in the interest of time. We believe that in order to create the best investment portfolios, we have to cast a wider net, and that diversity of thought, diversity of people leads to better investment outcomes for our clients. And so with that in mind, we have created internal and external goals. We are one of the only consulting firms that is very transparent. We issue, I believe you got it in our RFP response, our DEI report. That's a transparent illustration of what are we doing, where we were doing really well with regard to diversity and where we need to work on. And we do that purposefully because we think that things that aren't measured aren't achieved. If you go to the next page, we are also one of the only firms that has diversity goals by percentage, not only for our advisory clients, but also for our OCIO clients. So the assets that we have discretion over. So essentially, you see we are not only just recommending it for our advisory clients, we also believe internally for our assets that we manage that diversity is important. Another key takeaway in addition to those things is that NEPC was a founding member of IDAC, the Investment Diversity Advisory Council, under the leadership of Sam Austin, who does not love that I give him props, but he very much deserves it. This organization was really founded with the idea that in order to create meaningful inclusion within financial services, everybody had to roll their sleeves up and get to work. And so Sam and NEPC took a leadership role in that, and that organization is now a separate entity, a separate legal financial entity from NEPC. And we have several allocators, consultants, managers working to achieve the same goal. So I'll pause, see what questions we did not answer for you all.
I had a question concerning the asset allocation. And specifically, how individualized is the asset allocation given, for example, factors such as, an asset allocation for the sinking fund, which is approximately 73% funded, may be different than an asset allocation for a fund that is closer to 100% funded. Also, we have a CIO who is very knowledgeable, has been in the investment field for a long period of time, and trustees who are pretty active concerning decision making. So it's not an OCIO sort of situation. I notice OCIO is 26% of your business. So how do you individualize the asset allocation versus how you make recommendations out of your research team for your OCIO clients, and how are they different?
Yeah. So backing up a bit, if we're fortunate enough to work with you, we would ask a lot of questions, and that would help us craft a asset allocation targets that are specific to the sinking fund. So we understand you have a healthy funding ratio. It's not a 100%, but 72% is a pretty good funding ratio for a fund. Your expected return is different from other clients. So we take all these factors into consideration when we're crafting an asset allocation policy for you. We also think about things like how much comfortability you have with active management versus passive. What asset classes you're not comfortable with, and can we get you comfortable via education, or is this just a no-go for you? We have a lot of conversations, and we would look to partner with the commissioners and with staff to make sure that all those things are expressed in the asset allocation policy. So it would look, while there may be some similarities in the ranges or the top line for other clients, it would really be specific to the sinking fund, and it would be based on the things you want expressed in the portfolio. What's your comfortability? What's your risk return perspective, you all run a very lean staff. So we would also consider things like how many managers is 2 managers before staff feels overwhelmed working with them. You have some policies around divestment, around Sandy Hook and Russia. So we would look to kind of add those things as part of how we're constructing that portfolio from an asset allocation standpoint, and also from a manager selection, manager implementation standpoint.
Francis, if I might jump in with just a quick proof statement of our history, our track record of designing customized asset allocations for clients. I haven't looked at this recently, but the last time I did, which was the year ending June 30th, 2023, so a year ago, during that 1 year, of the 71 public funds greater than $1 billion in the investment metrics database, 5 of the top 6 performing funds were NEPC clients, and they all had radically different investment beliefs, different asset allocations. Some liked active, some liked passive, some liked private markets, some hated it. And by designing the asset allocations that were best for each of those clients, all the 5 of the top 6 were NEPC clients.
Yeah,
Another good example, actually, Kevin Leonard and I work with a client who is in Chicago. When we took over that client, they had a very struggling funding ratio. So they could not go into private markets. We felt like they couldn't go into private markets when we took over the portfolio, but we ran our analytics, like our liquidity studies, our asset liability studies, to really understand that they couldn't go into private markets. This was under a different credit regime, but at that point, because they couldn't go into private markets, we really rethought the risk return of their credit portfolio. And so we added things like opportunistic credit to add some additional alpha, and to clip a coupon, so that coupon that they were clipping really helped offset some of the pension liability. So we essentially kind of turned that portfolio from being 100% total return portfolio to being more focused on generating income, which can offset pension liabilities, into the funding ratio got healthier. And we were able to craft that portfolio because of the conversations and the collaborative nature of working with staff and helping them understand what we saw from an asset allocation standpoint.
And how closely do you work with the fund's actuary and looking at their projections and produce a stress test? Maybe.
That is funny you say that, because one of our clients' actuaries just emailed me to ask me a question as you said that. So I feel like you put it out in the ether, but we work very closely with them. So when we think about being an extension of staff, we want to make sure we are working in connection. Everybody's rowing the boat in the same direction. So we want to work very closely with the actuaries, with staff, with trustees that are part of the committee, to make sure that everybody is understanding all the pieces, all the ingredients that goes into making the cake.
Yeah, and I'll jump in real quick, Francis. Sorry to interrupt you. I just want to mention we do asset liability studies, and we do them technically every 3 to 5 years. They could be more frequently depending on if there are demographic changes to the fund, but generally during those asset liability studies, we will be stress testing the portfolio as well into different economic scenarios to show you how the funded status would change. And we can also show you different asset allocation mixes with those scenarios to show you how the funded status would change over time. And we stress test contributions, and there's all different levers that we could pull. So that is something that we work with all of our public fund clients, and we will do the same with you all.
Mm-hmm.
And we think in general, and I guess I won't speak for everyone, but based on my experience, that disagreement is okay. We think healthy discussion is a good way to get to the best answer. As a consultant, are you hesitant at all to jump in to a healthy debate? For example, probably be with the CIO, with CIO and staff. Is that an issue?
No.
No.
We prefer
We
that.
would welcome it. Yeah.
We
All right,
want to
thank
be
you very much.
challenged. Yeah, we want to be challenged, Francis. That's important. So I think that's
Yeah,
great.
we don't believe that we have a monopoly on good ideas. If somebody from research was here, they would actually tell you some of our greatest ideas come from a manager who a client sent for us to look at. So we don't think we have a monopoly on good ideas, and we really view our role as being a partner with you.
Thank you very much.
What other questions can we answer? Okay. Hearing none, we truly appreciate you all taking the time this morning to talk to us, and we would love to partner with you.
Thank you all. Really appreciate it. Again, would love to grow the NEPC family in Philadelphia. So would love to see you more frequently.
Thank all four of you on behalf of the commissioners, and I will be in touch to provide an update to you and the other respondents when they've made a decision. But thank you for your thank all four of you for your time this morning.
Great. Thank you, guys.
Thank you.
Take care.
Thank you.
Thank you.
Any questions for me before the final presentation from Marquette? Great. Hearing none, I will let them in.
Sport growth to all.
So, good morning. I believe we have Kwaku, Jessica, and Lee from Marquette. So, good morning. You're presenting this morning to sinking fund commissioners and or their designees that are in the room. You'll have roughly 20 minutes. I'll either try to put a hand up or shoot one of you an email when you're getting, closer on time. I will put your presentation up on the screen. So who's ever talking, just tell me, what slide or where you want me to direct things. And with that, floor is yours for the next 20 minutes or so. Thanks.
Great. Thank you, Chris. Good morning, everyone. And hopefully you can hear me well. Just wanted to do that quick technology check with you all. Perfect. So we'll jump into the introductory page. And before giving the very brief introduction as to who I am, did want to start with a very genuine and sincere thank you for the opportunity for Marquette to present. Very quickly, my name is Kwaku Obed. I am a managing director, a partner at the firm. Along with Lee and Jessica, I do represent part of the leadership at the firm. I come with 25 years experience. I do head up our public fund segment group, something that we're very proud of, and we'll talk about momentarily. And one other thing I'll mention here is the really interesting point we're at in the consulting industry as well as the investment management industry. Close to 12 years ago, I began a conversation with Marquette. I was then at the biggest investment consulting firm, still the biggest investment consulting firm. And one of the reasons for the conversation with Marquette and really moving to a different business model was the opportunity to do what we call real consulting. That's the blocking and tackling, it's the customization of client portfolios. And as time has gone on, we continue to see that in the industry, you have larger firms, they do the white labeling of funds, there's more complication in portfolios. And we really enjoy the art and science of investing and blocking and tackling with our clients. So really just wanted to leave you with that point with respect to Marquette. The journey I've had as a consultant, different cultures, different firms. And with that, I'll tee it up for Jessica to give a quick introduction.
Hi, good morning, everyone. My name is Jessica Naviscus. I'm the Associate Director of Alternatives at Marquette. So I sit on our research team and I oversee all of our alternatives and private markets research and manager source.
Thank you, Jessica. Good morning, everybody. My name's Lee Martin. I'm a managing director, partner in the firm, and like Kwaku, serve on our board of directors. And I lead our consulting efforts on the East Coast out of our Westchester office out here in the western suburbs. In my 25th year providing investment consulting services, primarily to public funds here in Pennsylvania. And back in 2010, I actually developed our OCIO program. So just like you guys, I've been working and acting as a fiduciary on client funds for the past 15 years. Also, a little bit of interesting information, maybe relevant today, just like the process you guys are going through today. back in 2016, I carried out a 12-month deep due diligence and discussions with 11 larger consulting firms. The outcome of that in 2017 it was that I merged my company, Pierce Park Group, into Marquette Associates. And I felt they were not only the best independent employee-owned firm in the business, but more importantly to me, I felt they would be better aligned with our clients' best interests. I'm happy to say 7.5 years in that was the case, as all our clients did come along with us, and they're still clients today. So that wraps up our introductions. Chris, if you could just take it to the next page. I'll take the first few minutes just to give a quick overview of our company. Thank you. And a smart man once told me at a finals presentation, be bold, be brief, be gone. So hopefully I'll stick to that rule today for you and get you back on track. So as you see right in the top of that page there, we're one of the largest independent employee-owned investment consulting firms, purely focused on providing clients superior risk-adjusted returns delivered by a high-touch boutique client service. For 38 years, our sole and only line of business has been investment consulting. An advantage within our firm there is we do not compete with other business lines for investment dollars to support growth. So all of our 130 plus employees are laser focused on providing best-in-class investment consulting services to drive positive outcomes for our clients' funds. And as you see in the bottom left of that page there, I'm happy to say we've been able to do that very successfully in the past, and that's why at 99% we have one of the highest client retention in the industry. And then just final point on this page, if you look at the pie chart there, you can see a little over half of the assets we advise to within our firm are for public funds, just like you guys, so a little over 200 billion. So actually, if you could take me to the next page, I'll just drill down a little further on that for you. Sorry, on page 4, if you could, thank you. So as you can see there, of our 78 public fund clients, actually 38 of them are right here in Pennsylvania. And as you can see, we've over $90 billion that we advise to public funds here in PA. You see, it's part of our DNA. It's what I built our competencies within our office here in Westchester around over the past 25 years. Because of that, we tend to be the go-to firm that's asked to come out and provide education to trustees just like yourselves. At most of the public fund organizations here within Pennsylvania, such as PAPERS and both municipal and county organizations. If you look at our representative client list down at the bottom there, you can see our public fund business tends to be more of a barbell approach. Consultants like Kwaku, Dave Smith, and I, we're more focused on the larger state and city funds. And then several of our colleagues, they are more focused on the county and municipal funds. But the biggest takeaway, I think, from this page is, is from our experience, we have an excellent understanding of all the issues that public funds like yours are facing and the factors that you need to consider when managing your investment program. So if you could take me to the next page, please. And actually, I'll just go over the next page very quickly. It isn't only OPA, we are across the whole country. And as you can see on page 5 there, all the way along I-95 corridor, we have many public funds that we consult to. There you go. Actually, the next page, great. On the independence here on page 6. Sorry, you can go to page 6. Thank you. That's the next page. So as a firm, we feel a tremendous value to our clients is our independence. we're able to offer our clients a fully transparent, open architecture investment program. So we're able to recommend any and the best investment strategies that are out there that have the potential to be accretive to your fund. Unlike many of our independent competitors, we don't put client assets or own white label proprietary funds, where it's not totally clear on exactly if there's any additional revenue being received on top of the consulting fee. Our program is fully transparent, no surprises approach, and the only fee that we receive is from you, the client. So you can see we're fully aligned with our client's best interests, and we're able to provide unconflicted investment advice to your funds. Next page, please, Chris, before I wrap up here in the next 2 pages. So on page 7, you can see some of the ownership within our firm. And as an employee-owned independent firm, you know, I believe we're far better able to control the future direction of our business and therefore better align ourselves with our clients' best interests. Our employees are the bedrock of our firm, and they really are our greatest investment. We like to recruit high-performance employees, provide development opportunities so they can be impactful within the business today. But more importantly, we've been able to provide a path for them to first become principals and then eventually full owners of the firm. And we strongly believe this helps us to retain, you know, top talent. But not only that, that in turn helps us to improve the services that we provide our clients today. But more importantly, it ensures our independence long into the future, which I feel is really important when we align our business with our clients' best interests. And then the final page for me, if you could, page 8. If we're fortunate enough to be hired by you, this would be our diverse team that would work as an extension of staff for you. As you saw within the RFP, Kwaku and I would be your consultants. As you heard earlier, Kwaku and I have been providing investment consultant services for many years, and well before the post-GFC free money environment that many of our peers in the industry today have came into the business since. So many years and seen many cycles that we're able to lean back on our learnings from those periods. Actually, within our firm, we prefer a team consulting approach, and we feel that actually works very well for Kwaku and I, not because we both grew up in the UK, but, you know, we're very good friends. We're on the phone talking about our clients pretty much every day of the week. An advantage to our clients' funds are at any time, you should always be able to get hold of one of us. Also, you know, if I'm unfortunate enough to be knocked over by a bus, you as a fund, you're not going to miss a beat. Kwaku knows exactly what's going on. The fund will continue to move forward. And finally, I'm local. So if you need to put a fire out and you need to meet with somebody straight away in person, I can jump on Scepter and be there in under an hour downtown. As you see to the right of us, we're very ably supported by both Alberto and Teresa, and they will do all of the heavy lifting, all of the paddling that's going away under the water. They'll take care of all your administrative needs and supporting materials, documentation. From a sort of a unique differentiator for us, if you can see our capital markets research, Greg Leonberger, you can see a lot of spaghetti titles after his name there. He is actually an accredited actuary, and we feel that that's great. So from our asset allocations, our strategy development, he is able to model in all of your liabilities and flows so we can better formulate a strategy for you and for your fund to give you the greatest probability of meeting your fund's future needs. And then finally, from a manager research point of view, we've assigned both heads of both traditional and alternative research to your fund, obviously because of the importance of not only Philadelphia, but our Pennsylvania clients. And we've also made considerable investment, and even here locally within our research group recently. So on occasions, we may bring in one of our local research folks too, if they could be supportive to the discussion. But do note again, as I said earlier, Quaco and I have been doing our own manager due diligence as well for 25 years apiece. So we have about 50 years between us. So many times we understand what type of managers and strategies as well may be best fit for your fund. So, Quaco, anything to finish on this slide? And if not, I'll pass over to you at this point.
No, that's perfect. And I guess a little transatlantic humor. The translation services would come for free as part of the engagement. So just wanted to mention that. But really quickly, on to the next slide, please. So I think Lee did a really nice job talking about our firm. Culturally, we consider ourselves different because we end up hiring folks with real world experience, meaning I came from the asset management side before joining the consulting side of the business. Prior to that, I had worked in another country. All of these things do add up to experience and a skill set that adds an advantage in our opinion. Lee is a PhD polymer chemist. He has written 10 patents. And again, that difference in thinking, that ability to bring your non-textbook, off-the-shelf consulting, we think that adds a lot of value to our client portfolios. So we think about, looking at portfolios. The goal is to build a portfolio that builds on the key themes that the client wants to see. Whether it's transparency, whether it's liquidity, whether it's more exposure to diverse managers. These are all things that we look to customize as part of the construction process. Be skeptical. As much as there's so much compelling information out there, particularly if you're a strategic investor, one of the biggest temptations is to kind of redo everything, right? Hit the reset button, do something else, not be left out. And ultimately, our job is to make sure that we kind of bring it back to the strategy. What's the strategy? Is the strategy working? And then ultimately, if the strategy is working, still being mindful of tweaks and additions that can be made to the process and to the model, but not return chasing, not being in this academic type portfolio that looks really good on paper, but then the reality of the portfolio is disappointing for clients. Be honest. That just comes with the role of being a fiduciary. Our job is to give advice that is in the best interest of the plan, the participants, and ultimately setting in line with the direction set by the board. The next slide, please. Takes us to how we look at asset allocation very quickly. I'm sure you've heard about other asset allocation processes that other firms use. Ours is going to be very similar. We use a Monte Carlo approach. There's a simulation over a 10-year period. We're looking at 100,000 scenarios. We're taking distributions at the tail as well as at the median. So ultimately, we consider our asset allocation process to be in line with what's best in industry standard. Our model is powered by GEMS, which is owned or run by a firm called Conning. A lot of insurance companies, asset managers also use the GEMS system. So very robust system that we rely on for our forecasts as well as our stress tests and our analysis. The next slide, please. This takes us to an example of how we look at the world. So very high level, you have your inefficient markets where you're looking to have more in the way of active management. You have your efficient markets, like your US large cap equity, where you're looking to have more passive management. And really in looking at that barbell of inefficient and efficient, looking at what's appropriate for the client, again, from a fee standpoint, return standpoint, product standpoint, this allows us to build portfolios that make sense for a client as opposed to portfolios that make sense for a firm, make sense for a marketing standpoint, but ultimately disappoint when the reality of the client's expectations, come to fruition. The next slide just takes us to some observations. Nothing here I think is shocking when we think about Marquette. Our approach, we're grounded in, again, the numbers. We like to look at research. We're big believers in mean reversion. We're big believers in not timing the market. Tactical decisions are important within the context of a strategic asset allocation and the rebalancing ranges, but we're not looking to hit huge home runs as part of the overall framework of the portfolio, meaning that we're looking for risks where we're compensated. We're looking for returns that are realizable, recognizable, and repeatable. And then ultimately, we apply this framework to both your traditionals as well as your alternatives. In an environment where fixed income is going through a lot of volatility, we may look at proxies for fixed income, but ultimately this does highlight some of our key investment convictions at this point in the investment cycle. The next slide, please. Just takes us to some very high-level thoughts and observations on the portfolio. So very quickly, the portfolio philosophically aligns very well with how we see plans of a similar size invested. One question we would have if we were lucky to work with you would be the discussion around alternatives. We have a 10% allocation in small caps. That 10% allocation in small cap could in fact be a good basis of a discussion on, is that too much volatility? Can we take some equity market risk off the table? And if we do that, how can we be very, very thoughtful? The next couple of slides really just tee up our research capabilities. And I think on the research capabilities, we'll add a little bit more color to the comments I mentioned earlier. We'll turn it to Jessica momentarily. But as we think about research, this is definitely an area of the firm that folks like Lee and myself, we love to interact with. So we're leading our client relationships, we're talking with our clients, but then we're challenging our colleagues in research with respect to what are the ideas that will work for this specific client portfolio, as opposed to an off-the-shelf idea. Ultimately, we're staffed by a team of very experienced, dedicated individuals. We have some good analysts that are up-and-comers in the industry. And one thing I'll mention about Jessica, because she's, I think, too humble, she came from the alternative side of the business. So again, when we think about meeting with managers, discussing things with managers, she's been an investor and fully understands the jargon that's thrown to clients, the reality of particularly the alternatives market and some of these higher momentum, high growth areas that everyone looks to be getting into right now. So with that, Jessica, the floor is yours.
Great, thanks, Kwaku. And I will try to keep comments brief. I know that we are pushing up against time here. So starting with our research team. So today, just under 25 folks at the firm dedicated to research. The bulk of the team is comprised of asset class specialists. So these are experts that we fully rely on to opine on asset allocation, to source top quality managers, to complete due diligence on managers, just being incredibly thorough and making sure we're always acting in the best interest of our clients. On the next slide. So one of the key ways that we like to bring value directly to our clients is through published capital markets research and client-focused asset class education. So as Kwaku mentioned, one of the observations on the portfolio is limited exposure to alternatives. So if that is something that you are considering, an in-depth review with a research analyst can be really helpful. We have background educational papers, educational webinars that can all be accessed by our clients. We're able to provide regular trustee education. And also on the day-to-day market updates. So especially in a macro environment like this, the latest inflation number and employment reports and what the Fed is thinking and what that means for all these different asset classes. These are things that our research team is thinking about every day. So to the extent that that is helpful, we try to package that up really neatly and make it really accessible to our clients. On the next slide is our manager search process. So our team utilizes a formal 4-phase due diligence framework. This is across traditional and alternative markets to make sure that each manager that we recommend to our clients has been fully vetted. So this process is qualitative, it's quantitative. We're fully underwriting a track record, really with a focus on go-forward performance and what that manager can be expected to do in the context of a full portfolio going forward. Full operational due diligence. We do an on-site visit. We do reference checks. That's really leveraging our own network. And we have internal committees that review all of this work. So each fund has to be passed through each phase of this work by a committee comprised of research folks, consultants, really making sure that we leverage all of the different perspectives, as Kwaku mentioned, real life experience of all the different investment professionals at Marquette. The next slide, really briefly here to the point of of doing this due diligence. You provided your existing manager lineup, and our team is already familiar with all of these managers. So just noting the last time that someone from our team has connected with that manager. So all this to say, if we're fortunate enough to work with you all, our team would be ready to hit the ground running here. On the next slide, this is really the last point out of research. We just love to highlight our tech. So this is the hub, as we call it. It's our proprietary manager database, and it is just through and through really integral to all the work that the research team is doing. So it's integrated with all the third-party platforms. So we're pulling in that data. We're combining that with all the data we receive from managers, from our client statements. We have a ton of performance analysis tools in here, so it helps us underwrite all of that work. So we save all of our manager meeting notes, so and all of our due diligence work. So we have commentary going back a decade. So that really helps us, hold managers accountable, to keep everything organized. And we also map out all of our exposures in here. So I think this is one of the most valuable pieces of the hub, and kind of the goal is highlighted a bit more on the next page. But on one screen on the hub, we have access to which clients have exposures to which managers and which consultants work with those clients. So on the next page, what this really allows us to do is keep our clients updated in real time. So if there is ever a manager update, if something goes wrong with a service provider, a regional bank, perhaps, if there's something that requires action on a portfolio, research is able to push these updates out through the hub. Consultants get them via email or their phone. It's a push system, not a pull. And then that consultant can have a conversation with the client, and nothing gets missed related to a manager, which could be to the detriment of the funds that you all are responsible for. Wait, you're on mute.
Oops, Gen X. On to the next slide, please. So with respect to working with Marquette, on behalf of Marquette, I definitely want to say Jessica, Lee, and myself, again, want to say thank you for the opportunity to present. In addition to how we work, how we interact with clients, the onboarding process is also a way of establishing just how much we are entrenched with our clients. We would say that we pride ourselves on very seamless onboarding. We understand the importance of data, the timing of reports, the timing of deliverables, and we really make that straightforward, where there's literally a single sheet of paper that you would have to sign if you were to onboard Marquette. We would pass that sheet of paper on to your service providers, and we would take on everything from that point onwards. So a very quick turnaround when we think about getting your data up and running. Teamwork, I'll mention this, both Lee and I are big Premiership fans. So as we think about work, as we think about the work environment, we like to kind of drill in on the team aspect of what we do. Teams are only as good as their last game. They're only as good as their last strategy. So we like to look at the world through that lens. As we think about the administration side, we have some excellent people. Alberto Rivera cannot speak more highly of an individual. Alberto carries a lot for clients. He loves clients, and he really, really just puts the client service forward. And then the customization, again, in this environment, I think we hear more and more from firms about what clients should be doing in terms of, you should be doing this, you should be doing that. I think subconsciously and cynically, there's always the underlying notion of, okay, well, you're pushing this because it's higher margin and it's more profitable for you, but is that the right thing for the client? I feel that we're still nerdy enough, square enough, open and transparent enough, and as owners of the business, we look at all the recommendations we make, and we're trying to look out 5 years, 10 years, 15 years. What does it mean for that portfolio? So that deliberateness, I think, sets us apart pretty tremendously. The next slide will really just begin the conclusion of our presentation. The reporting is, transparent, very straightforward, and something that we turn around in a very quick fashion to our clients. We use Paris, a transition from Investment Metrics, very large, sophisticated reporting platform. And then finally, on the fee page, the next slide just talks to the proposed annual fee. This would be inclusive of all services and travel. As Lee mentioned before, our business model is a very transparent one. The fee is a flat fee. We're not going to charge you for extra services, extra meetings. Every time you guys ask for something, we kind of pride ourselves on the fact that it's all encompassed in that single fee. So I would say that makes the Marquette team unique. the real world experience, the diversity of our team, the managers we hire, the performance track record of our clients. It's all something that we're very proud of. So with that, we wanted to thank you again. Appreciate the opportunity to present. We would love to partner with you. We would love to work with you, extend the relationships that we have within Pennsylvania. We would love to put our best foot forward. So thank you again for this opportunity. Happy to take any questions if there are any.
I have a question. Lee mentioned earlier that he developed your OCIO program. And he also mentioned, this is his quote, "what I've built in Pennsylvania." So my question is this, how many of your Pennsylvania clients, Lee, are OCIO clients?
Okay, so mine personally, outside of the state of Pennsylvania and PMRS, pretty much all of my other clients at this point are OCIO. But out of the Pennsylvania office, that's obviously a lower number. They're not all OCIO, but within Pennsylvania office, it will be about 2/3 would be OCIO.
So then, Kwaku, you mentioned customization, and
Yes.
Obviously OCIO is limited in customization to some extent. Lee, let me finish. So obviously you could customize the OCIO model, but Kwaku, you've worked with the municipal fund. You know that OCIO is not something that the sinking fund CIO, Chris, is necessarily interested in, nor are the trustees.
Yes.
That was one of the points of contention with the outgoing firm, the OCIO model. So my question is, how customizable is your advice for the sinking fund versus making OCIO sort of recommendations?
So Lee, I'll take this very quickly and then pass it along to you.
Yep.
So as Lee mentioned OCIO and something he built, one of the really unique things about the OCIO platform that Marquette has is the open architecture nature. So it's not off the shelf. You're not looking at just one model, one strategy, one approach. So one of the benefits of having someone like Lee that's built the OCIO platform is the fact that from a macro standpoint, from a tactical standpoint, he has built a culture of customization in an area of the market where a lot of people are off the shelf. So the OCIO, we view that as a badge of honor with respect to an extension of the services that we can provide our clients. But ultimately, as we think about the sinking fund, servicing of the sinking fund, discussion around investment strategies and options of the sinking fund, it would be, again, sitting down with staff, sitting down with the board, getting a sense of risk sensitivities, getting a sense of any hot button issues around certain types of managers, management styles, active, passive, and all of that would be incorporated in the portfolio that we put together for you guys. That's also an identical approach that the OCIO team goes through as well. So we're a little different from other firms that do OCIO because the customization is what really sets us apart. And where other firms have gotten into trouble, particularly the bigger firms, is there's a lot of groupthink. There's a lot of, okay, everyone's going to do this. We saw this with PIMCO, where a lot of OCIO exposure was in PIMCO. All of a sudden, Bill Gross acts up, and then there's so much exposure on the OCIO side. We never had that issue. We have PIMCO, we had WAMCO, we have LM, GHA, other firms on our OCIO platform. So as a result of that, some of the same pressures you see from our peers, we didn't face. So I would definitely give Lee credit for that. And that's one of the reasons why we merged with Pierce Park as opposed to another firm. Lee was doing due diligence on us. And really, as you think about a partnership and a firm culture that works, Lee's strategy, his approach to looking at the world, his curiosity, his background as a scientist, all of these things really set us apart. So, Fran, hopefully that answers the question. We wouldn't come in with this is what you have to do. We would come in with, these are all the tools available. Let's have a discussion and figure out which tools can help us chip away at the problem that you guys want to essentially get to.
Yeah, and I was not suggesting that an OCIO model is not customizable, but what I was suggesting is an OCIO model is not something that we're necessarily interested in
Sure.
right
Absolutely.
now. Yeah.
Absolutely.
Yeah,
What was, you mentioned the merger and maybe you or Lee would like to talk about this. Was part of the reason for the merger is for Marquette to get a foothold into the OCIO world? Because Lee seemed to have pioneered that for you guys?
So from my side, obviously, that's a great question, by the way. From my side, I had an older partner as well, and I could have at that point gone and bought that partner out. But ultimately, I wanted to take everything we developed and have the opportunity to go and work with states and big funds like yourself. And that is why I decided to take the firm to basically a larger version of us, very collegiate, independent, employee owned, with the focus purely on client service.
Okay. All right. So Quaker, what percentage of Marquette's business was OCIO prior to the merger?
Oh, so prior to the merger, Lee, we had about it was about 10% of the business, right? I want to say prior to the merger.
Yeah,
with Pierce Park.
maybe a little less than that. And then obviously then when we joined, it went. I think it went to 10 or just over 10%.
And now you're about 20%.
About 15. Right? Yeah,
Yeah.
Somewhere around that line. But just again, so you know, I developed this more for the smaller funds that we had at that time. They didn't have investment staff like you. They didn't have the expertise. And I saw in 2008, during GFC, a lot of these boards froze, and just, having them dial back into equities at the right time and take the emotion out of things. I think what we developed was something that really helped those smaller funds really keep their funds on track. And so not so much about developing an optimum model or whatever, but every client's funds was customizable. They're all quite different, many of them, but more so just the operational lift and the rebalancing, ensuring the cash flows are there, taking care of all the administrative things behind the scenes for them. We're able to keep the funds on track, and that's why many of them are in such better position from a funding point of view today. So it was never really directed for larger funds like your funds. And as I said earlier, PMRS, state that I work with, and also, a couple of the larger counties too, we still are just traditional investment consultant.
Yeah, it's a great tool. It's a great tool for those who want that. I get it. And even a great tool, even a great tool for those who don't want to use it exclusively for other things. I get that.
Sure.
So what size would the sinking fund be compared to some of the local funds? I know it's not a large fund like the municipal fund, but what size would it be in the relative universe of the funds that you consult for? And you can limit it to Pennsylvania, Lee. That's fine.
So I say this is directed to me. Okay. I would say very similar to couple of the larger county funds we have here and also in Maryland. From a similar size point of view, obviously smaller than PIMA's fund. That's $3.5 billion. But then I also have some funds, in the $100-200 million range too. They tend to be more the OCIO ones. Right. So you somewhat kind of in the middle, I would say, from a size point of view.
And then my final question concerning the asset allocation, and you talked all of you talked about that in some respects, but the asset allocation, how closely will you work with the sinking funds actuary and look at their projections and do stress tests in order for the trustees and the CIO to be able to determine what is the best tweaks to make to the asset allocation?
So, Fran, Lee, I'll just jump in for this really quickly.
Okay.
Just to say that we would work very closely with the actuary. Our experience has been around asset allocation, around the bigger picture. When you set that and you get it right, and you've gone through debate, discussion, analysis, and review together, that makes the journey, the quarterly journey, the month by month journey, whenever the meetings happen, it allows for a very informed discussion around these are our expectations. Is the portfolio meeting, exceeding, or behind expectations? And then it brings back, okay, what risk exposures did we tweak? Which risk exposures should we have had? And so on. So we work very closely with the actuary. Greg and his team would be part of that conversation. We've stress test portfolios for clients. We review the asset allocations on a periodic basis, and we would look to continue that process and that culture that we bring to our clients with the sinking fund if we were hired. So absolutely nothing would be done in isolation, and everything would be done to make sure that we understand the risk sensitivities, the risk tolerances, and so on of the various board members.
Thanks.
Yeah, and I'll just oh, sorry, will you continue? I was just
No,
going to
thank
add
you.
to that
Yeah.
just very quickly. That look, we have one job. Our main job is to ensure that what has been promised to people for post-retirement benefit, that they receive that in the future, and that is always front and foremost in our mind. And you can't invest the assets without really understanding the liabilities. So right from the get-go, I pour through actuarial reports. We look at it holistically, and only when we have a great understanding of the liabilities, then we can match, short, medium, and long-term assets to meet those liability needs moving forward.
And Lee, this is just out of curiosity, the PMRS, that's about 3,000 little municipalities throughout Pennsylvania, right? Isn't that the coordination?
It's a lot of the smaller munis. Mm-hmm.
That must be interesting. I mean, they all must have different funding. How does that work? They all must have different funding levels, right?
Yeah, they do. So they all have to have their own individual reports every 2 years, 205 reports. And that they're all pulled up together, and it actually has a much lower discount rate, assumed rate of return target than you would see normally out there. So they're only like about 5.25. So it's a pretty safe fund, and actually it's a great question, because actually when we took over there about 4 or 5 years ago, we came in, it was invested to achieve over a 7% return, and there was so much risk involved, and you're over 100% funded. So straight away, you look at the liabilities, you look at the target returns, we're like, well, take the foot off the gas a bit, let's de-risk this. We want more certainty from the year point of view, and that's worked very well for them recently.
Well, I'm glad you said that, because that's one of the things when we talk about individualized asset allocation, the fund itself,
Sure.
What's its funding percentage, how many members, what's the project, they're all important factors. So I'm glad you said that.
Absolutely. There was just a bit of a disconnect, as I said, because they were managing assets in isolation. So we look at it holistically, and how do you bring that together?
Perfect. Thank you very much for answering all those questions. Thank you.
You're welcome.
Christy, Don, anyone else? Any follow-up questions for Jessica or Kwaku or Lee?
No.
No?
Not for me.
All right, well, Jessica, Kwaku, Lee, appreciate your time answering all the questions this morning, going through your presentation. And once the commissioners have made a decision, I will reach out to the three of you to let you know if there's any next steps and what the outcome was.
Thank you.
Thank you.
Sounds good. Thank you very much.
Thank you all.
Have a great day.
So with that, I'm happy to entertain any questions. If there's anything on the staff report or anything that was said by either Marquette or NEPC that commissioners would like to discuss, and then you folks can let me know how you'd like to proceed.
Christopher, in terms of Marquette, and the services that they're providing to the city of Philadelphia, would they be providing the same to us as they're currently providing to the city?
Yes, the only exception to that, Don, would be assuming that assuming the commissioners chose or continued to not be invested in alternatives. Obviously, then they wouldn't provide that service, but right now they do serve as the general consultant for the larger fund, the municipal fund, and all the reporting, all the research, all the attendance at staff meetings, the phone calls, manager selection, etc. Focus on, DE&I, women and diverse managers. They provide all those services and research to the staff for the municipal fund now.
So do we need to have an offline conversation about the general opinion in terms of the quality of service that they provided to that fund? Or is that something you can respond to?
No, I can absolutely. I'm not uncomfortable responding to that. On the general consulting side, look, we've worked with them since 2016. And they took over or wound up taking over, Don, at a very, very difficult time for this fund, not only in terms of where we were funding level wise, maybe some of the investment decisions that prior folks had made, but we also lost the then CIO very suddenly, about 6 or 8 weeks into their tenure. It was a very, very difficult time for the staff, and I think the board by extension. They jumped in the short term, took over a lot of additional responsibilities while folks were recovering. And I think, again, I don't want to speak for, Christy. I know this is her second kind of tour on the board. She's relatively newer. Obviously, Fran has been the executive director of the other fund for, I think, about 13 years now. But from my perspective, Don, everything that the board and staff have asked them to do, they've done. The fund is in a significantly better position financially and funding wise, I think quality of manager wise, than we were back in 2016. Now, obviously, that's a collaborative effort. Trustees deserve the, overwhelming bulk of the credit for that. But it's definitely been a collaborative effort with the trustees, Marquette, staff, other partners, the actuary. I will say they are very open to disagreement, and the board has disagreements with them at times, and they're always very professional. If the board has a different opinion or staff on real estate or private equity. And so I think the quality of service has been very high. And I have overall very, very positive things to say about the now 8-year or so relationship we've had with Marquette.
Thank you.
Don, I'll just add to what Chris said, is that during that period of time in 2016, I actually was acting as the interim chief investment officer for the fund. So I worked very closely with Marquette during that time and with the trustees, and they have been exceptional for the municipal fund. I will say that. Now, I will say we have never worked with Lee, who presented today. We have not worked with him, but his answers to the questions I thought were very helpful. So if that helps at all.
Yeah. Any idea why they have such a concentration of business in Pennsylvania?
I don't offhand, Don. I think they have a fair number of clients in Maryland too. I know that. I think they work with at least one of the Baltimore plans and a couple county plans. They have a decent concentration out in Chicago, and in the Illinois area. I think that their primary kind of geographic area of focus has been, let's call it the Rust Belt or the Mid-Atlantic. And I think to Kwaku and Lee's point, I think the fact that they partnered or absorbed Lee's prior firm, probably explains at least why they have some, limited client concentration in Pennsylvania, because so many of his former clients were already in the area.
Got it. Okay. All right. And size, how many ownership partners? I can't recall. In terms of the ownership of this entity, how many partners are there?
I believe he said 25, but I'm just going to pull the report back up, see if I have it in there. And yes, 100% firm ownership by 25 partners for Marquette.
Okay. All right. So what do we normally do in a situation like this? Do we reflect and come back with a decision, or do we make a decision on the spot? How do we normally address major
I'm ready to
decisions
make a
like
decision.
I think, Don, this is a little bit of an unusual situation because, we have the outgoing consultant and our meetings are held quarterly, right? So I think, I think in this case, I'm ready to make a decision also.
All right, well, let's make a decision.
I make a motion to hire Marquette.
I second it.
Okay, we have a motion and a sec. Oh, I'm sorry, Don. You're back in charge. Go ahead. Sorry.
Oh, no. But let me sit on the sideline. Go ahead, Chris.
We have a motion and a second to hire Marquette. All those in favor?
Aye.
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 Okay. Well, thank you. I will be in touch with them and NEPC as well as PFM later today to begin the transition process, and then obviously connect them with Adam and his colleagues at the law department to work on the contract. The only new business I had was just to mention a couple things real quickly about the next meeting, September 18th. We will have the annual actuarial presentation. The folks from Aon will come in. They'll have access, obviously, to all the fiscal year numbers, update us on the any demographic changes, funding percentage, etc. And then I think at the November meeting, in light of the fact, obviously, we have a new consultant, and I think it's good practice, which we've gotten into over the last several years. We can ask the new consultant to do the annual or the initial annual asset allocation review under their stewardship. So just a little preview of the next two meetings. That was all the new business that I had.
That's a general question. Transition normally takes how long?
They can take a while, but Don, I would expect in this case, given the pre-existing relationship with Marquette, the fact that I believe they're the only vendor in the history of the time I've been with the city, either at the law department or pension board, who has signed a contract with the city without making any changes. I believe this should be a fairly seamless and maybe as quick as 30 to 45 days. I would think that by the time that September meeting rolls around, there will be little, if any, hanging things with PFM that we need to wrap up.
So is there a termination date with PFM?
I can look, Don. I know they sent me something about mid-August. I've had some preliminary conversations with Adam if we need to pay them for a couple more weeks. I don't necessarily want to, I can talk to you offline, or Adam can, about the legal issues. I don't necessarily want to get into those in a public meeting. But I think within the next, 4, 6, 8 weeks, we should be done paying PFM, and then under contractor notice to proceed with Marquette.
Yeah.
Chris, I just had one more. I had one more thing. Don and Christy, I don't know if you felt the same way, but I had some level of concern with the Sky Harbor merger discussion that PFM had. It struck me as not timely, that we should have known about this prior, but it seemed like it'd been going on for some period of time. So if that restructuring, I know they wanted to put Sky Harbor on watch, and I do agree with that, but even more so, I'd like the new consultant to take a very close look at the merger and what effect that would have. It raised some level of concern. That's all I'll say.
Yeah,
I would say,
go ahead.
I'm not certain if I fully appreciated the downside of this merger. And I'm not sure if he went into a great detail around that. It was very casual.
Yeah, I'll be happy to. I only received notice of it myself within the last several days, I'll say. So it's not something I've had an opportunity to jump into in depth, but certainly with the folks at Marquette, on an immediate basis, I will solicit their opinion, report back to the three of you on that. And if it's something that, they believe requires additional action, then that's certainly something I'll bring to your attention in a timely fashion.
Thanks, Chris.
Thank you.
Anything else before we wrap up? If not, there's a motion to adjourn, then we can conclude the meeting.
So moved.
I'll make a motion.
I'll
All right.
second the motion.
Right. The ayes have it. Thanks everyone for their time this morning, and enjoy the rest of your week.
Thanks,
Thank
Chris.
you.
Thanks,
everyone.
Christy.
Thank you.
Thanks, Don. Thanks,
Thank
Adam.
you.
Everybody.
Thank you.